Lucid Group is currently trading at $6.29, marking a slight intraday increase of about 0.32% as of early trading on Monday, April 27, 2026. While that tiny green flicker might look like a sign of stability, the reality beneath the surface is far more volatile than a simple percentage point suggests. Most investors look at Lucid and see a struggling luxury electric vehicle maker that has watched its stock price erode from double digits to the low single digits over the past year. They see a company that recently touched a 52-week low of $6.17 and assume the story is one of terminal decline. However, what the broader market is missing, and what explains the recent spike in call option volume, is a massive pivot in the business model that was recently solidified through a high-stakes partnership with Uber. We are no longer just looking at a car company trying to outsell high-end sedans. We are looking at a firm that is essentially becoming the hardware backbone for a global autonomous fleet. This shift from consumer luxury to industrial-scale robotaxi infrastructure is the expectation versus reality gap that is currently defining the trading volume. The common narrative for anyone using an online investment platform or browsing investing sites is that Lucid is a cash-burning machine with no clear end in sight. To a smart friend looking at their individual brokerage account, it seems like a lost cause. But the deeper take is that Lucid has just secured a commitment from Uber for at least 35,000 dedicated robotaxi vehicles. This isn't just a pilot program, it is a fundamental restructuring of Lucid's total addressable market. When you look at the Apple stock or Nvidia stock of the world, investors value them based on their ability to create an ecosystem. Lucid is attempting to do the same by integrating its software-defined vehicle architecture into Uber's network. This move has triggered a wave of institutional activity, with entities like Goldman Sachs increasing their positions to over 5 million shares. Even though the stock has been hammered, down nearly 16% just in the last week following the announcement of a new CEO, Silvio Napoli, and a fresh $1.05 billion funding round, the smart money is looking at the long-term infrastructure play rather than the immediate retail delivery numbers. Recent stock movement has been a roller coaster of high-volume sell-offs and speculative buying. We saw a massive 400% increase in average session volume last Tuesday when the Uber stake was disclosed. For those who invest online, these kinds of swings are usually a warning sign, but in this case, they represent a transition of ownership. The reality of Lucid's current situation is a clash between its technical brilliance and its financial sustainability. On one hand, the company is still reporting negative gross margins of over 100%, meaning it costs them twice as much to build a car as they sell it for. On the other hand, the new Atlas electric drive unit and the upcoming Cosmos and Earth models on the midsize platform are designed specifically to fix that. These new vehicles, set to start production by the end of 2026, are targeting a sub-$50,000 price point. This is the catalyst everyone is waiting for, but the market is currently pricing in the risk that Lucid might not have enough cash to reach that finish line without further diluting shareholders. If you are tracking your portfolio through the Fidelity mobile app or the Robinhood app, you've likely noticed that Lucid's price action is highly sensitive to news about the Public Investment Fund of Saudi Arabia. There is constant chatter about a potential full takeover by the PIF, which already owns a majority stake. This creates a floor for the stock, but also a ceiling of uncertainty. While you're checking your SoFi active investing account, you have to weigh whether you are betting on a car company or a geopolitical sovereign wealth fund. The technical setup right now is precarious. The stock is trading well below its 50-day and 200-day moving averages, which sit at $9.67 and $12.58 respectively. This indicates a strong bearish trend in the medium term, yet the surge in derivatives activity suggests that some traders are betting on a massive short squeeze or a surprise announcement during the upcoming Q1 2026 earnings call on May 5th. Institutional activity is where the real story is hidden. While retail sentiment on the Robinhood trading platform might be mixed, the institutional side is seeing sophisticated players use interactive brokers and other professional tools to hedge their bets. The recent $1.05 billion capital raise, while dilutive, provides a lifeline into the first half of 2027. This is the reality that is currently battling the expectation of bankruptcy. The market expects a slow fade-out, but the reality is a heavily fortified balance sheet backed by Uber and the Saudi government. This tug-of-war is why the stock can jump 5% on a Tuesday and then give it all back by Thursday. It is a battle of convictions. For those looking for investment help, the question isn't whether Lucid makes a good car. Everyone agrees the Lucid Air is a technical marvel. The question is whether they can manufacture it efficiently enough to stop the bleeding. Comment below how many shares of Lucid Group you currently hold, or if you think the Uber partnership is enough to save the company. I'm curious to see if you think the robotaxi pivot is a genius move or a desperate last stand. To understand where Lucid is going, we have to look at what they actually do and how their business model is changing. Historically, Lucid has been a pure-play luxury EV manufacturer. Their business model was simple: build the most efficient, longest-range electric sedan in the world and sell it to wealthy early adopters. They succeeded on the technical front, with the Lucid Air winning numerous awards and outperforming Tesla stock in terms of range and luxury finish. However, the high-end EV market is small and increasingly crowded.
To survive, Lucid is now shifting towards a two-pronged approach. First, they are expanding their consumer lineup with the Gravity SUV, which is expected to have 6 times the market reach of the Air sedan. Second, they are diversifying their revenue streams through software licensing and the aforementioned robotaxi fleet. This is a significant departure from the original plan, moving closer to the intelligent portfolio approach where revenue is spread across hardware, software, and services. Looking back at past performance, Lucid's history is one of grand ambitions met by harsh manufacturing realities. They have consistently struggled with production ramps and supply chain bottlenecks. In 2025, they saw a 54% increase in deliveries, which sounds impressive until you realize the baseline was quite low. The reality of their production target for 2026, between 25,000 and 27,000 vehicles, is the bar they must clear to prove to the markets that they are a real player. This is a far cry from the hundreds of thousands of units produced by competitors, but for Lucid, it's about proving unit economics. If they can show a path to positive gross margins with the Gravity SUV, the stock could see a massive re-rating. Investors using the Fidelity trading platform or Schwab Intelligent Portfolios often look for these inflection points where a company moves from concept to viable business. The future outlook for Lucid is entirely dependent on 3 major catalysts over the next 18 months. The first is the successful launch of the Lucid Gravity. If this SUV can capture the same prestige as the Air but at a higher volume, it will provide the cash flow necessary to fund the midsize platform. The second catalyst is the deployment of the first robotaxis in the San Francisco Bay Area later this year. This will be the first real-world test of Lucid's autonomy and software-defined vehicle claims. If successful, it could lead to more deals with global ride-sharing platforms, turning Lucid into a technology provider rather than just a car company. The third and perhaps most critical catalyst is the production start of the Cosmos and Earth midsize models. These are the vehicles meant for the mass market, and they represent the ultimate goal of the company's long-term strategy. However, the risks are just as significant as the opportunities. Persistent supply chain issues, potential changes in government EV incentives, and the constant threat of a price war initiated by larger players remain major hurdles. For someone managing a self-investing strategy, these are the known unknowns that make Lucid a high-risk, high-reward play. If the reality of their execution falls short of these ambitious goals, the stock could remain under pressure regardless of how much capital the PIF or Uber injects. The market is currently in a show-me phase, demanding to see tangible proof of manufacturing efficiency and software reliability before it grants Lucid a higher valuation. The tension between the incredible engineering of the cars and the difficult reality of the car business is what makes this such a compelling, if stressful, stock to watch. In summary, the central insight here is that Lucid is no longer just a luxury car brand. It is transforming into a fleet-scale technology provider. The expectation of a slow decline is being challenged by the reality of massive new partnerships and a total overhaul of their production strategy. While the current price of $629 represents deep skepticism, the institutional buying and the $1.05 billion in fresh capital suggest a foundation is being built for a different kind of company. We've seen how expectations contrasted with reality in the past, leading to the current all-time lows, but the pivot to the mid-size platform and robotaxis represents a new chapter. Whether you are using Fidelity Investments, Robinhood Investments, or the SoFi trading platform, the data points to a company that is either at the bottom of a very long trough or on the verge of a significant structural recovery. The authority of Lucid's engineering has never been in question. Now the market is waiting to see if that same authority can be applied to its balance sheet and production lines. As the market moves through 2026, the success of the Gravity and the first Uber deployments will be the ultimate judges of whether this pivot was the right call. The depth of the current sell-off provides a unique perspective on how much risk the market is willing to stomach in exchange for a seat at the table of the future of mobility. Stay focused on the production numbers and the margin improvements, as those will be the true indicators of Lucid's survival. Like this video, comment your thoughts, share with your friends, subscribe for more updates.